Well, hello, everybody. Welcome into the Wealth Guardian Show. I hope you're having a wonderful morning. Brice, of course, is here in the studio with me. And Brice, how's things going?
Well, Doug, it's going, isn't it? It's going up, it's going down, it's going sideways, it's going somewhere in a basket.
Yeah, it is.
I'm doing all right. My daughter, the last time that everyone tuned into us on the radio, we were talking about looking like my trip out to Europe to visit my daughter for her spring break because she's doing a semester abroad. It looked like that might not happen. And how things advance in a week, because not only is that not happening, she is now back over here. And right after the show, she got called by the university saying, is everybody interested in staying or coming home? Within 6 hours, that message was scrapped, and they said, forget that, you're all coming home. And so she had to get on a flight. That was Friday. She had to get on a flight Monday from Heathrow into Charlotte. And, of course, I watched the news and I saw all those long lines at O'Hare Airport of people just waiting for hours on end to get screened before they could come into the country. And I was texting her a couple of these pictures saying, this is not going to be pretty for you. I don't know how it works if you're standing in that line and you have to go to the bathroom. Do you have to go back to the end of the line? It's not like these things are predetermined. Doug, no lie, when she got into Charlotte, she was through customs and out the door within 30 minutes. There was no screening for her at Heathrow, and there was no screening for her whatsoever in Charlotte. Not putting that little thermometer to the head and testing them, nothing. So she's back home safe and sound now, but she is in self-quarantine for 14 days.
Sure. Boy, things are happening fast.
Really?
We found out, we were going to go to Ireland for our 40th anniversary in May, and that got canceled this week. Yeah, we're going to talk again as this whole crisis continues. Our show will be dedicated to that. But before we get into it, as normal, we want to just shout out and thank all of our vets, our service members, and especially our first responders in times like this. We really appreciate what you guys are out there doing for us.
And the families as well, absolutely. Yeah. And let's give an extra shout out, Doug, to not only our servicemen, our first responders and women, but let's give a shout out to everybody out there whose business, whether you're self-employed or whether you work for the man, thank you for all that you're doing, because I know times are not easy for most of us out here right now. So, we're acknowledging you guys as well out there on the front lines of this coronavirus thing. Yeah,
and folks, do your best to go support them, the restaurants especially. The service sector is just getting hammered right now.
It really is.
Brice, this is my fifth bear market. 4 professionally and 1 as an investor like you folks out there are now. And I'll never forget that one. That was Black Monday of 87.
I remember that one.
Couldn't get a hold of my broker for a week.
Oh, my gosh.
Well, you remember there was no internet then.
There wasn't, so you just had to wait for him to take the call.
Yeah. Being this is my 4th bear market professionally, they're all different. We said last week we expected a bear market at some point.
Well, we've been saying that. We've been saying that for years, actually.
We didn't know what was going to cause it. My last guess would ever be some flu bug from China.
Right. That was not on our top list. This is what I think.
No. But, folks, it's pretty doggone serious, and I think we're finding that out every day now. I mean,
reality's hitting us.
Pretty much shut down. The service sector shut down. It's market is last Monday hit 30% down, and let me put this in perspective. Our market topped on February the 12th. Last Monday was March the 16th. It dropped 30% in just a hair over a month.
Absolutely correct.
Now, everybody remembers 2008. That market topped in October of 2007. It didn't go 30% down until nearly 1 year later.
12 months.
We have seen a huge amount of financial destruction in an incredibly short period of time. And we haven't had 2 back-to-back positive days since right before the top in February the 12th. The volatility is through the roof. Now, I hope I'm wrong, but I think we've got further down to go.
I don't see how we don't.
Yeah. I will tell you, our clients are safe and protected. We have circuit breakers, stop loss in all of our portfolios. They've been 100% protected now for over a week, and their maximum drawdown right now is sitting around 9-10%.
Yep.
And, that has been a hallmark of our planning now for years, because as a retiree, as a pre-retiree, you cannot go through 20, 30, 40% to the downside.
On top of that, Doug, we don't know that the market is done. Like we're talking as if in a certain way we're thinking, well, this is the bottom. Well, we have no way of knowing that. In fact, you and I believe we're not at the bottom or even anywhere close to it. And so for somebody with the market at this point down 30% and our clients only down 9% in their overall portfolio, that brings a certain peace of mind, which is evident to us because our phones are not ringing off the hook.
No, they're not. And, if we go back to 2008 again, that market didn't bottom until March of 2009. And when it did, the Dow and the S&P were down well over 50%. I think that lends precedent to say this one's going to go further down. Don't you have a trivia question, and then we'll get back to the market? I
do have a trivia question. So, folks, as you know, before we go to break, I try to break out a trivia question just to test all y'all's knowledge. So, speaking and keeping in line with market crashes, and Doug, I think you know the answer to this, but I haven't told you what this trivia question is. So you're hearing this for the first time, like everybody else out there. We had the recent crashes of the tech bubble in 2000. We had the 9/11 2002 crash. We had the real estate bubble bust in 2009, also known as the Great Recession or the financial crisis. So my question is, one of the earliest crashes in recorded history was a market crash in 1637. And I'll give you a clue. It was in the Netherlands. It was mostly impacted in the Netherlands. What was to blame for the market crash of 1637? I'll give you a clue. It wasn't a tech bubble. So here are your choices. A shipping route dispute, a silk shortage, a tulip bulb bubble, or a March spring ice storm. So what was the market crash of 1637 in the Netherlands caused by? Shipping route dispute, tulip bulb bubble, silk shortage, or a March spring ice storm? So I'll let you all think on that and come back with the answer after our break. But we want to keep going here.
I'm pretty sure I know the answer.
I think you do, because I've mentioned this to you before and you were aware of it.
Hey, listen, folks, before we go to break, I just want to say this to you. If you are in a situation right now where you're down 15, 20% and you're close to retirement or in retirement, and you've been practicing the same old buy and hold Wall Street approach, please come and see us and get a second opinion. We don't do buy and hold. We protect our clients. Come in and find out how we do it. That offer is free and there's no obligation. All you got to do is call us at 336-391-3409.
What's that number?
336-391-3409. And also, if you want to do it virtually, meaning via a telephone and a computer, not come into the office, we can do that too.
We are set up for that. We have been set up for that.
We have that capability. So again, get your second opinion, 336-391-3409. And I think you'll be glad you did.
Doug, whenever we have a conversation with a client, particularly when it revolves around risk, when we're analyzing their current portfolio and talking to them about the risks that they feel like taking, they feel comfortable taking in order to try to achieve some gains, and then we show them the kind of risks that they're actually taking with their portfolio, obviously, most of the time, those are not completely synced up. Well, when we have that conversation and we put their portfolio through some stress tests, we've been referring to the Great Recession, the financial crisis, which is now 10 years, 11 years old. We are now at that point. We're now officially in a bear market when the market has dropped 20% from its high. We are now able to have that conversation in modern day speak, like it's happening right in front of us. And that is a really eye-opening conversation. And as we've been talking to people for the last week, the people come into our office or meeting with us over the phone, they realize that they don't know that this is the bottom, but yet we can tell them, not with a guarantee, but with some real confidence, that there's not a reasonable way for our clients to really lose any more money in the market, because our programs are already fully hedged. They can't go down, and something really strange would have to happen for them to go back up and then come back down. Now, we know false bottoms have happened before, and they might happen again, but this is a really unique situation, and I think when the market starts to come back around, it's really going to start coming back around and not have as many false bottoms as we had in 2000, 2002, or 2008. What are your thoughts on that?
Well, I tell you, I am extremely happy that on our equity positions we have put in place those circuit breakers. It's trademark Beta Shield, that's what it's called, and it worked flawlessly.
Better than what it had in 2000 and 2008. We've been referring to certain numbers in the past on how much you could go down, and this actually stopped faster than it had in the past.
Yeah. And it's going to be eventually, when this market does turn around and go back up, I think it's going to be very interesting to watch how it stages back in the market.
Yeah, like I said, I don't think there's going to be a lot of false bottoms, but I don't know. I don't see it going back up, skyrocketing back up like it's fallen down, because I think there's going to be some economic hits that are going to take some time to recover. But anyway, folks, as Doug said, if you right now are not comfortable, you've heard us talk in the past, and you think, well, I'll meet with them eventually, and now all of a sudden you think, well, maybe that eventually is right now, you can give us a call. It's 336-391-3409. Again, 336-391-3409. You can also reach out to us on our website, or look into us on our website. That's www.thewealthguardians.com. We're living history right now, folks, and we're not out there trying to scare you or anything, but you have probably seen what your portfolio is doing, and realization is probably hitting you that now is probably a time to sit down and talk with a professional. And remember, we work as fiduciaries. So when we sit down and make recommendations on how to adjust your portfolio, we are making recommendations that are in your best interest, not ours.
And remember this, folks, I've had this show on the air since 2007, and one of the things I've always said is we try to tell you what you need to hear, not necessarily what you want to hear. And sometimes that's tough medicine.
Good point, Doug. Okay, folks, well, we're going to take a quick break here, and when we come back, we will come back with the answer to that trivia question of what was the blame for the market crash of 1637. Hang tight.
You're listening to The Wealth Guardians Show with Doug Ray and Brice Payne, serving you in the Triad and beyond. Let's get back to the show.
And welcome back to the Wealth Guardians radio show. I'm Brice Payne. Doug is here. And for our listeners who are 5 to 7 years from retirement, and you just want to take a minute and confirm that you're actually making the best decision for your retirement, well, the good news is that, as always, we offer a no-cost, no-obligation second review, so you can learn how you retire the job, yet keep the paycheck. And if that sounds like what you want to talk about, you can give us a call at 336-391-3409. We can meet you here in the office, or we've also been set up to meet with you virtually as well, if that's the way things are going right now. Now, before the break, folks, we asked a trivia question, and that trivia question was, in 1637, in the Netherlands, there was a huge market crash. And what was to blame for the market crash of the Netherlands of 1637? Was it a shipping route dispute? Was it a tulip bulb bubble? Was it a silk shortage? Or was it a March-spring ice storm? And Doug, you and I have talked about this. I think almost every advisor or somebody who's worked as a broker or whatnot is aware of this one because it's so unique. What was it, Doug?
It was a tulip bulb mania.
How about that? That's what it was called, the tulip bulb mania, and they were trading those like it was precious metals.
They got the prices of those tulip bulbs up to what was the equivalent of 7 years' income. And then all of a sudden,
they realized.
They said, what are we doing?
This is nuts. These are flowers that die at the end of the season.
Kaboom!
And they kind of figured things out. It's like, we should not be spending 7 years of income on bulbs. And yeah, so it was not a shipping route dispute. It was not a silk shortage. It was not a spring ice storm. tulip bulb bubble crash. All right. Well, if you knew it out there, pat yourself on the back. And I bring that topic up, one, because we're going through a crash right now, and two, it's spring and my wife is out planting her bulbs right now as well. So hi, honey. Hope you're enjoying that one as well.
And three, I'll add this. I hope it brought a little smile to your face out there, because we could use a little humor right now.
We always can, but yes, in these times particularly. All right, Doug. So in the first half of the show, we were just talking, we were playing this casually, and we're talking about the current market cycle, because if there's any time to do this, it's right now.
Well, we did talk about the market, and things are unfolding so fast. It's amazing. I've been trying to watch the press conferences they have every day about the response to not only just the coronavirus, but also what the administration is trying to do to help soften the blow to the economy.
Right.
And the one thing, break, I was telling Brice, I said, the one thing I've noticed on each of these conferences, these folks are absolutely serious. There's not a smile on any one of them's face. And if you read between the lines there, that tells you that, we're dealing with something that's a bit out of the ordinary. I said earlier in the first part of the show, this is my fifth bear market, 4 as a professional. They're all different, but to me, this one feels even worse than the financial crisis of 2008.
And that's what other economists are saying as well. It's not just you.
Well, look at what's going on here. I mean, the Mnuchin came out last week and said there could be 20% unemployment.
20%.
20%.
What was our unemployment peak back in the financial crisis? Was it 12%?
It was, it wasn't 20%. It was 10, 11, 12, something like that. And also look at oil prices. Oil has been decimated. Mm-hmm. Now, you got a smile on your face when you go to the gas pump every week and it's down and down and down, but here's what's going on. Oil prices at these levels are decimating our oil shale industry. Mm-hmm. We're going to see bankruptcy after bankruptcy after bankruptcy. It's a trickle effect. The airlines are not flying. The cruise ships are docked up. The restaurants are closed.
There's not as many trucks out on the highway.
Except for Amazon. It's different. It's not, I've heard some of the talking heads on the business shows say, this is going to be a V-bottom recovery. As soon as we get behind the coronavirus, it should burn itself out in a month or two. Then we're going to snap right back to all-time highs. I hope they're right. I just don't see that happening. There's just been too much destruction for a snapback rally like that.
Oh, we're probably talking to a lot of the people out there right now who are aware of this better than we are. They're sitting at home this past week, not going in and earning a paycheck by no fault of their own, of course. And that means that people will be struggling to get back on their feet for a long time after this. They're not just going to get right back out as soon as the virus is gone and start spending discretionary monies again like they had been previously. They're going to have some catching up to do.
That's exactly right. And you go into the grocery stores now and you still see bare shelves. I mean, no toilet paper, no hand sanitizer. I went into the grocery store last week and they barely had any eggs.
Yeah.
So this one's different. This one's tough. And I think that it's going to take us a while to get through it. And
Doug, how you can tell, going off of what you said originally, you think that they're serious here. You can tell that they're serious. One thing that leads me to believe that they're serious is Mitch McConnell is actually out there talking about passing a bill. Right now. That's not something he normally comes out and does. He's known out there on various sides of the political aisle as the Grim Reaper because he simply doesn't bring bills to the floor. Well, here he's not only talking about bringing a bill to the floor, he's talking about bringing one of their own bills to the floor and sending it off to the House. That does not happen a lot these days.
Well, and here's another observation. There's less and less bickering and sniping back and forth between Republicans and Democrats.
Very true. They're on the side. They both realize that we have to work together here. And when was the last time that happened? 1637, like around the Great Crash?
Exactly.
Yeah, it's been a while.
Yeah.
It's been a while.
Well, the good news is we built our clients' retirement plans for a time like this. And I can sit back and I can rest, and Brice and I can not rest on our laurels, but be thankful that we did build their retirements for this because they're safe right now. They're down a little bit, but not nearly like the market is. And folks, if you are in a position where you're pre-retirement or retired and you would like a second opinion, if you'd like to find out how we protect our clients from the downside and give them exposure to the upside, I'd love to have you come and chat with us, and we can, do it virtually over the phone, or, we're still accepting appointments in the office until, the powers that be say we cannot. And it's worth it. It's worth it for you to get that second opinion and figure out how to protect yourself. Buy and hold, Wall Street's old buy and hold, and I have been preaching this for years, doesn't work. We've got volatile markets now with computer trading. They can be up and down in a split second. So just don't go with the old adage of you got to be in the market to make money.
The buy and hold strategy, Doug, that is, while not ideal, it's an acceptable strategy for somebody who's in their 20s, 30s, or 40s.
Agreed.
But there is no need to be as volatile as the market. Now, volatility is not that bad if you're dollar cost averaging into your 401k account on a biweekly basis, as you should be, because right now you're buying share prices on sale. So you're buying more shares with your $100 or $200 monthly contribution. But when you're close to retirement, volatility now becomes your enemy. And so if you've imagined yourself retiring with X amount of dollars 2 years from now and being able to spend so much of that in retirement and have the retirement that you're envisioning, and now you're looking at, right now you're looking at 2/3 of the amount that you had. 1/3 of that is most likely gone, unless you were one of our clients. That changes your outlook for your retirement. It means that you're either not retiring when you thought you were, or that you're going to not have funds last as long as they were going to, or you're going to have to greatly reduce the spending that you wanted to have in retirement. Well, none of those situations are ideal situations. So our clients, we were working off of a model, the portfolios that we've been constructing for our clients, we've been back testing those in what happened in 2000 and 2008, and they worked really, really well. Well, now we're seeing it in real time, how it works today, and so far it's worked even better than what our models had shown us that they would work back in 2000 and 2008. And our clients right now, as you said, are no longer susceptible. Last Monday, Doug, when that market went down 13%, our clients didn't feel any of that. That day, they were out of the market. And thank goodness, because our phones would have been ringing off the hook. And our clients are seemingly, they're not 100% happy, of course, because nobody's happy when the market is doing what it's doing. But they knew that they were protected when they came to us and they looked at our plan and they realized this is sensible for me as I'm approaching retirement. And now they've seen the proof in the pudding.
Yeah. And let me say this to you. If you're thinking about our offer as a second opinion, and you're also saying to yourself, well, gee, I've lost so much money, I can't make any changes now. Let me say this to you. That's a perfectly understandable, natural human reaction. But it's probably the wrong action to take now. And let me explain why. If you go through our process and you decide it makes sense for you and your family, and you decide to move to us, when the markets eventually turn around and go back up, you're going to go back up with us too, and probably even faster than where your portfolio is positioned now. But if we're right about where this market's headed, and if it's got a date with lower numbers, you're at least going to be protected with us. So again, I encourage you, get that second opinion. It's not going to cost you anything. There's no obligation.
It's 336-391-3409. Again, that's 336-391-3409. You can also visit us on the website. We have one of those things up there too, and it's www.thewealthguardians.com. And of course, you can go visit us and read more about us on the Better Business Bureau's website as well.
Yeah, we're coming to a close of this segment, and I sure do hope next Saturday or Sunday when we talk to you again that we got better things to talk about. Maybe we're starting to see the curve in this virus start to roll over and go down.
hopefully, of course, the other option might be that radio waves don't exist a week from now as well.
Oh, Brice.
No, that's probably not going to happen. But folks, again, there has been so much damage done. We probably don't have to tell you that that your industry has probably suffered to some degree in this as well, or people that have, and that's not going to turn around on a dime. So, folks, again, you can give us a call, 336-391-3409, if you're interested in sitting down with us and talking about our thoughts on where the market's going and what kind of reaction your portfolio might have and what the market does next. We're happy to help you out and just give you some information on that. Well, folks, thanks for spending some time with us this weekend. As always, we look forward to seeing you again next weekend as well. Stay safe out there.